Good morning. Thanks you guys for tuning in this morning for FIGR Technologies earnings. We're going to be covering a lot of numbers here, and of course, from my work setup, so a little bit lower quality. So hopefully, you guys can still hear me and see me all right. But not low quality earnings. These look absolutely great. Let me go ahead and throw these up. We'll look at the not so much the slide deck, but the posting of Figure as well. Figure Technologies own post, and then they're coming out at let's see, in about an hour, hour and 15 minutes will be the earnings call. So we'll have a little time here. We can talk some other names too if you have questions. And if you're wondering what Figure does, it's a complicated company, but it's a really good one. The market, no huge reaction yet. Ran up about 10% yesterday, kind of in expectation and related to, of course, what was happening with rates and CPI. Morning, guys. Yeah, the numbers. Let's take a look. They were really good. Okay, and I'm used to, by the way, all these other guys usually being the driver, so this will be a little bit different. But let me blow this up here so we can actually see this. This, I think, is just a really quick snapshot just to kind of show you how tremendous these numbers were, and then we'll look at why, and we can pull up some graphs and charts. Okay, the revenue came in. It's a smaller company, so we're talking about millions, not billions. The estimate was 208 million, by the way. And we'll see in a little bit that one of the concerns, and you can see this in business, sometimes you take a massive leap forward and then you just kind of plateau there for a few quarters. That's not a concern for these guys. Between the Kiavi acquisition that they, well, I'm sure talk a little bit more about here during this earnings call, but even without that, 113% year over year. The quote from Mark Cagney, by the way, he's the same guy that founded SoFi, is, "Hey, you can't grow at 100% forever." And then Mike Tannenbaum, the guy that I interviewed, the CEO of Figure, said, "Well, so far we have. It's not that they will forever. These are smaller numbers, but really good growth, well ahead. So beat on revenue. They crushed EPS. So 35 cents versus 24 cents. I'm sure they'll talk about that in the earnings call as well. Up 338 year over year. It's up from a smaller base. These guys IPO'd last year, and they're one of the few companies that actually IPO'd profitably. And they're just like, well, we're not optimizing for EPS. That's not the goal right now. The goal is to capture the market share and grow our revenue, but we can't help but be profitable. So that's pretty nice. Yeah, the earnings really nice. So uh, yeah, 35. That's the big one. Now a couple interesting things too. Adjusted EBITDA, of course, is a nice beat, 126% year over year. Consumer loan marketplace volume. We'll look at some of the breakdowns of this. This is the guide. This is up. They have been growing. So they're putting out weekly and monthly numbers now, and you can just see the acceleration that's happening there. Connect volume up 262% year over year off of a smaller base. A lot of the products, by the way, in parts of their platform that they've launched are a year old or maybe a little bit less as well. So some of these you'll see like nothing as far as a year over year comp. That's just because they're brand new. And it's part of the reason why there's so much ridiculous growth. This was one of the quotes that we'll look at here. Weekly applications are now surpassing 1 billion as of July, and the pending completion of our Kiavi acquisition. The Kiavi, that they're calling this a year of the first lien, and so they're moving heavily into the mortgage market. Traditionally, they started with HELOCs. That's not where they're stopping. That just was a natural starting point. And of course, they're doing quite well. The only number that I saw, yeah, this right here, operating income was just slightly down. They're building a lot. They're doing a lot. I don't think that's a huge deal at all. And margin was one of those focuses of analysts last quarter. It's nice to see that up. They talked about it just because of the product mix and the mix shift that there might be some margin pressure, but not this quarter. And it's not a lot of margin pressure either. They've guided for that and done that very well. So we can see here is the breakdown of the numbers. Let's see. I've not looked at these. I was coming in. This is again my workplace, so I'm like, hey, at traffic lights I can stop and take a look and see. But other than that, I didn't have time to read this. So here is what they said. We delivered our strongest quarter yet, headlined by 132% year over year volume growth in our consumer loan marketplace, in addition to over 100 origination partners. The partners you'll see are absolutely scaling. I asked the CEO about this in the interview, and he was like, "Well, not every partner is exactly the same. In other words, they bring someone, and like sometimes one partner is worth 100 others, but a lot of people are adopting this platform, and it's awesome to see. The scaling of our capital light marketplace with 65% of our volumes now on Figure Connect. Used to be when Figure was approaching and trying to build out these HELOCs, it'd approach these customers, these banks, and it'd be like, "Hey, here's what we're building." They're like, "That's awesome. We'll be the 10th to use it." And so they're like, "Okay, we got to actually show and proof of concept ourselves and deliver some of the volume." But they built a platform, and this is asset light revenue, and it's so efficient with what they do with cryptocurrency that I don't know how you can compete with these guys. And so why compete? Why build your own? Just use their platform, and that's what is increasingly happening. So weekly applications now surpassing 1 billion as of July. In the pending completion of the Kiavi acquisition, that was a quote that we read, which we expect to significantly grow our platform into adjacent asset classes. Yes, they've talked about it. They made it clear with this acquisition, like it is accretive, like immediately. It is beneficial because it helps them build out that first lien. But boy, they are like this 100% year over year growth. That's probably going to continue at least through the next year, and so that's awesome. We're accelerating the growth of our flywheel and our first mover advantage in bringing capital markets on chain. Okay, so here's the consumer loan marketplace volume, net, see loans held for sale. Yeah, cash and cash equivalents totaled 1.4 billion. They did do a raise, a senior convertible notes related to the Kiavi acquisition, but yeah, it's not because they're running out of cash, but they are a lender. They do some in-house lending as well. They have to demonstrate proof of concept, so they need some on the balance sheet as well to lend against. And then let's see here, net income margin. Yeah, it's nice to see that up, 38.8% versus 33.7%. That's, I mean, look at this growth here. That's just awesome. Um, Select metrics. Okay, here we go. Consumer loan marketplace. You can see like this right here, and then the Figure Connect volume especially. Like it's just ridiculous. Okay, yeah, the take rate, that was the one that I was looking for. So just because of the product mix mostly, that's what's happening there. The take rate is since they're building a platform that's asset light, other people are using it. There is a known fee when you do use that when you complete these loans on the Figure platform, and that take rate is going down. It's one of the things that analysts really keyed off of last time when we did to 3.7, and they did talk about like the long term. I think it's 3.5 is what they think it'll settle at long term. So shouldn't be a surprise. Let's see. Yeah, the quality of the mic is probably not very good because I don't have a mic. I just have this right here. It's from the workplace environment. So I apologize for that, but it's the best I can do today because I need to get an early start at work. We're actually down in the pre-market by 3.5%. So yeah, I'm not sure if it's the take rate being down by 0.1% or not, but yeah, they shouldn't be trading here. This is one that's probably going to take a little bit of time just because of the overhang of what's happening, of course, with the uncertainty of the rates and also what's happening specifically with cryptocurrency. That even though the price of crypto doesn't really matter for Figure, I mean, it does just a tiny bit. It's, the market's like, oh, crypto, ick. And so there's some overhang with that. So we'll have to see what actually happens here. Yields is, of course, their stable coin. It's the first SEC registered stable coin, and it's one that they can natively offer yield no matter what the Clarity Act falls at. Much like SoFi, it's positioned very, very well. And then democratized prime, you can see the matched offers and its lending supply. Let's see if we can find the partners. Operating outlook. Here's the guidance, by the way. Yeah, 4.8 to 5.2 billion, which is really nice and robust. Okay, let's look at the recent business highlights. I don't see the partners yet. Figure Connect reached 65% of the consumer loan marketplace volume in a quarter. Oh, here we go. Added 102 origination partners in the quarter, reaching 489 total active partners across mortgage banks, depositories, servicers, and fintechs. That's a lot of adoption and growth. Usually, so they did a good job in when the slide deck comes out as well of talking about how this usually scales. And it usually takes about 2 quarters once they've onboarded to like really start ramping up to that volume, just because platform is new, you're figuring out how to use it, you're onboarding and everything. They are accelerating that as well. But yeah, this is basically showcasing like this revenue bump that they've seen here. This phenomenal growth is going to continue. It's very durable. New product categories continue to accelerate with small, medium businesses, loan volume increasing. So the platform that they're building, like one of the misperceptions of the market is these guys just do HELOCs. That's where they started. That's not where they're ending. This is a platform that it doesn't matter what the lending category is, they will be able to do that. And they've built a lot of that as well. Some of these are very, very small, and some will take grow, in high interest rate environments better, like that the HELOCs. Others, as rates come down, if rates come down, I should say at this point, who knows? They'll do quite well, especially the mortgage market. Yeah, the rule of 40 is now 150. That's probably about right. I don't know that they break that down in the slide, but in the slide deck, I believe that they do. And so, yeah, it's ridiculous. I actually own Leaps on FIGR and shares as well. Um, I think by quarter two of next year, the numbers will be impossible to ignore, and the market is forward looking as we emerge from both crypto winter and also midterm election cycle stuff. I think all fintech is going to do really well in quarter four. These guys will be certainly a part of that. And the mortgage market's the one thing. So they're trying to move into that. And the way that they're doing it, it's going to be tough to compete with these guys, especially in the smaller loans that are under $300,000. They can issue and back in them faster than just about anybody for extremely lower rate than anybody as well. So it's not the I'm not talking about the interest rate for consumers. I'm talking about the cost for them to actually do. So a lot of times these smaller loans, the banks that offer them, they're not making any money in the product just because it's so expensive. And so they have, just like they did with HELOCs, they have ironed out a lot of the inefficiencies. They're very vertically integrated. And so the Kiavi platform is also going to help bring volume in that and demonstrate that proof of concept beyond just like, hey, we can do this, we are doing this. No, like, look, here's the actual number. So the mortgage market itself, I was talking to a realtor, a realty developer, and also a realtor as well, a little while ago, and they talked about, of course, what's happening. It's really, really slow right now. Obviously, I don't think that surprises anybody, but there is some thought that there's some things that are basically happening that are preventing foreclosures from really ramping until maybe really close, maybe right at election or just after as well. So that will, between that and a couple other things, there might be some pressure on the mortgage market. Not going to be massive. We're not talking a huge wave, but it is something that I think the market may not like initially. So for leaps, actually my leaps are in the money now just because sold off figures so far. I'm like, might as well just go ahead and buy some of these. But I have them as far out as far as time, and obviously pretty close to the money. So just be careful with that. Shouldn't be trading here, but there is that saying that the market it can be irrational longer than you can be solvent. So just kind of keep that in mind. Okay, let's pull this back up here. Third-party borrowing activity on Democratized Prime reached 170 million. This is one of those very new products. So the 23 times increase, I mean, it's true, but that's when you start off with a tiny, tiny base, it's not a big deal. But it is great to see this. The small and medium business pool, the small business, that's one of those asset classes that they've added. The auto loan, Agora is one of those partners there, and you can see the volume. I've been not paying attention to it every single week, but yeah, they've been doing some really nice volumes there as well. And of course, the home equity stuff is their bread and butter right now. And let's see, strong operational efficiency as operations processing costs declined to approximately 67 basis points of consumer loan marketplace volume, down from 79 basis points from quarter two 2025. So they just continue to get better at these efficiencies. And then the Kiavi transaction is on track to close in the second half of 2026. That's going to be a very nice revenue driver as well. So, okay, let's then look here, and I'll just show you some of these numbers that are happening. Let me just pull up the EPS first because that one's real easy, and we'll do it this way. So yeah, when you can see there, it's not all up in a straight line. They've done and they've built a lot, but yeah, this second highest EPS number that they've ever had. There was a one-time thing that benefited them back in September 2025, shortly after they recently IPO'd. I wasn't a shareholder at the time, but I was watching them closely. But yeah, this is a nice acceleration. I'll be very interested to see what they mention as far as the full year EPS, well ahead of analyst expectations. And then we can see, let's see if the KPIs are listed here. Yeah, a little bit early in those. Fiscal AI does a great job of updating the headline numbers really quickly, and usually waits until the 10Q sometimes, or a little bit later to update the KPIs. So we'll look at those in the earnings review itself. And let's see. Yeah, the effective tax rate is one of the things that's helping the EPS, of course. Okay, let's see if there's any questions that you guys have. Hey guys, good to see you. You're welcome. Yeah, this is one of those companies where uh, the market just doesn't understand. It's more complicated than when you first look. You're like, oh, they're a lender. Well, I think what's really unique about them is there's a lot of lenders that are like, hey, crypto is really going to help us out, just iron out some efficiencies, but they don't understand that natively. And you could bring talent in, but again, if your leadership doesn't really get it, doesn't really have a clear strategy, it takes time to really build that out, and it's hard to do well. And then there's also crypto native firms that are like, hey, let's get into lending, but they don't really understand traditional finance. And so they might have like a great product, but they don't know how to market it. They don't know how to sell it. They don't know how to gain volumes. Like one of those, maybe not the best example, it's because it's not a lending product, is when Circle, which issues USDC, that they're like, hey, we're getting into payments. It looks like a good offering, but yeah, the volume there, it's not done what a lot of people had expected. Um, so you have $25 leaves for January. Yeah, that nice conservative strike. That's very good. Yeah, Lone Warrior today. It's a little different. I'm not used to that. Do we think we get a pullback in AI today? It looks like it. So yeah, this week has been just a doozy for myself, just with all the different companies that I want to cover. I only have a portfolio of 10 names, so when it's a confluence of all these names all at once in the same week. Of course, tonight we're also going to do a data center monthly, but yeah, a lot of the AI names really, really rocketed. We of course saw the numbers from CoreWeave, which was up about 20%, Nebius, which was up more than 35% yesterday. Sorry, Michael Burry, he doubled down, but when you have great earnings and there's upgrades, the stock continues to go up, and that's great. But when you go up 35%, when you go up 20% in a day, there are profit takers. There are people that are like, hey, like they jump in because they're traders and they're speculators. So it's pretty normal to have a pullback. Doesn't mean it's going to last all day. It might last a few days. It might last a week. We'll see. But yeah, would not surprise me if we continue to see a pullback. We were seeing that in the early market hours as well. Uh, Alex Karp was rated the least trustworthy CEO on CNBC poll about how they'll handle AI. That's strange. Yeah, I guess it depends on who you're polling, right? Yeah, Batty is one of those that has not only invested in Figure by the way she's used it, and so yeah, she can agree. Like they are great in terms of what they offer. Who are Figure's competitors? So there are a ton depending on how you look at it. If you're like, who else does HELOCs? Who else does first lien, the mortgages? Who else does auto lending? There's a ton of those guys. Who else is building a platform? There's a few others as well. A lot of them are private and they're smaller. Figure is one of those that it's just a juggernaut in terms of its growth, even though it's still small size. It's hard to look at these guys. So some of the competition that's out there is they've not proven themselves yet, and we'll have to see. These guys won't be the only ones building a platform, in other words, but they are meaningfully ahead. One of the things that you'll hear probably on the earnings call, and they've talked about it all year, is that they're Fannie Mae. And so if you look at Fannie Mae themselves, I know you can like look at the stock and see where it's at and everything, but in essence, they are moving into this first lien market, and they do see themselves as being able to capture that. Why? Because they've demonstrated already proof of concept through what they've done with HELOCs, and it'll be the same thing. Different category, of course, from second lien to first lien. Um, Blockchain is allowing Figure to get 15 times better margins over traditional finance. Yes. And no, I'm not in PayPal. I got out with their quarter four earnings call. Literally in the call, I sold what I could, and then as soon as the market opened, I got out of the rest of it, bought a bunch of different names. all of which went up immensely. So let me throw up one of these efficiency things that I think was is really helpful to kind of understand what they've built with HELOCs, and then you guys can see um, and have a little bit better understanding. It's very visual. So it's one of these articles that I wrote on Artemis. Give me just one second. Oop, that's not it. Okay, pulling up my articles. Give me one second here, guys. Yeah, it's so much harder going from having another person that's doing this with me versus like, hey, I'm just on my own. So I love it. I was like, hey, I want to be here, but none of the other guys really care about FIGR that much. So you know, all right, here it is. So with FIGR themselves, this was the image that I had in mind. If you guys can't see it, let me know. But you can see, because this is where it talks about, no, this is not what I was looking for, actually. That's the TAM of all these different assets that they've been building. Um, maybe I didn't have it in the article. Bummer. But yeah, this by the way was the Figure Connect volume slide that I mentioned. They have over 100 new partners this quarter, and so this is what they've talked about, that when they onboard, it actually ramps really rapidly, and within 6 months you see about a 200% volume increase. A lot of these partners, I would imagine, except for maybe just a handful, are on the smaller side. But yeah, they will absolutely scale. And again, when you're adding 100 partners and you continue to add partner after partner, it's a flywheel that just continues to grow. I think that they're positioned incredibly well. Uh, you've said that in the past that you believe Figure will be a 10 to 20x for you. What time frame is that on, and what are the key factors and metrics that Figure will need to accomplish to make that happen? The first lien market that they're moving into, it has to be successful. Agora is going to help, I think, drive that volume. That's that's over like I think if you look at 10 years, I think it's a 10 to 20x. I think the 10x can happen in as early as maybe 5, 6, 7 years. But with that, a lot of it is tied to rates. And so well, two things. Rates, if they remain elevated, if they go up, that's not great for any lender, even though they're just fine because, again, there is lending that's going to happen. And in a rate environment that is not favorable to lenders, they want all the efficiencies they can. So it's not that Figure will do nothing and that they won't grow. But then the big driver right there is because if you look at the TAM of a lot of these products, is that first lien marketplace, which they're uniquely positioned to serve those smaller loans. If the mortgage market remains a dud for the next decade, probably won't be a 20x for sure. Probably won't be a 10x. Still will be a nice return. I mean, we might be looking at a 5, 6x from here. Probably a little bit higher, but I'm just saying it conservatively. Now, do we expect that the mortgage market is just going to be dead for the next decade? No, it's cyclical. We go through these seasons where people are. It's not the same as crypto, but it's kind of the same idea with any cyclical asset where you're like, oh, this is a nothing burger. It's never going to move. It's never going to get better. And honestly, there are challenges in this space that are, you can see with especially some of the younger um, people that want to own houses. I have a son, well, I have two sons. One's in college and he's just focused on that. One is in career mode and he's like, Dad, I don't know if I can ever own a house. You don't love hearing that. And like the thing is, if it was just him, you'd be like, okay, whatever. That, don't think like that. A ton of young people think that way because the house prices have risen so much higher than the wage, and then the rates are really, really high at the same time. It's depressing if somebody wants to own versus just rent. So yeah, the bear case is essentially that we have a environment where the mortgage environment is just a dud, and that there's more competition coming on, like with SoFi with HELOCs, and these guys stumble somehow with execution, which they've executed very well. I don't expect that, and then it's still cheap from here. It just is. I mean, it's hard to look at this kind of growth that they're doing 100% year over year, and they're probably going to do it for another year, year and a half, could be longer as well. That Agora onboarding is going to really help them in the second half of the year, but they would still be putting up fantastic numbers. They're cheap. They just are. But yeah, the bear case, It's the same thing as any lenders out there. So if we see, by the way, I actually haven't pulled this up this week. Let's look at market expectations in terms of rates because that's one of those big things. Of course, I know many of you guys know and like SoFi too, but this weighs on every single lender there, including Figure. And so we can see, yeah, the rate expectations, not cut expectations, they've gotten a lot better. I figured it did with the CPI read. We jumped from a 15% expectation. This is through the end of the year, so there's three more Fed meetings. And so 15% all the way up to 27%. We might get one rate hike. I always thought that two was really, really misguided and very unlikely given the timing of a lot of different things. And so we're down here now to 24%. There's always a chance of two hikes, but yeah, a lot of people are like saying, hey, there's going to be one rate hike. And that has usually fallen in September, what expectations are. Right now, it looks like it's more favorable for just standing pat in September. And I don't think it's unrealistic to think, hey, there's going to be no rate hikes at all this year. So if this is way off sides, if we get no rate hikes, we're into the end of the year, and instead we're just here at where we're currently at 350 to 375 basis points. Figure, SoFi, Lending Club, all these guys are going to do a lot better than what is expected. And they guide according to what the expectations are, not what they'd like to see. So, keep that in mind. So I actually really like it when I'm holding something and I'm able to buy something. And I actually added a little bit to Figure this morning. And it's the expectations are really, really bearish when it comes to what's happening in the macro. It's not going to last forever. So, all right, let me pull up that efficiency slide. I know where to get that article right quick. It'll take me just a moment. And we'll pull up articles and figure themselves. Okay, that's actually the wrong one there. Yeah, I want you guys to see this. I think it's important to understand. It just puts it visual. Like uh, the perception towards crypto right now is very unfavorable just because we're in a crypto winter, but that doesn't mean that you suddenly lose all the efficiency gains. It's why they've had so much ridiculous success. I think that this might be it. By Mario. That's Agora. Not sure why I'm not finding this. Let me Let me pop in on X real quick and see. The call, by the way, is going to start here at I believe it's 8:30. Yeah, 8:30 Eastern time. So we have a little bit of time here as well. So if you guys have questions or you're seeing something unrelated to this of other things that I hold or might know, or even if you don't know if I own it, I'm glad to talk about this too because we have a little bit of time this morning. Um, I'm curious how many of you guys are CoreWeave or Nebius shareholders as well, if you ended up taking some profits yesterday. So, all right, let me search for this on my and right here. This should be, and then if I don't find it here, I will go ahead and see if the slide deck is out. Yeah, I don't have it. Okay, let me see if their slide deck is out here rather than just the release. Okay, second quarter conference call earnings presentation. Here we go. Now it's loading. Let's try that again. Nope. There. Blow this up a little bit. All right, so here is that at a glance number, the visuals of the numbers we've already seen. Again, really, really fantastic. Yeah, they are getting into other businesses as far as lending. So it's all about lending the small and medium businesses, SMBs. They're doing lending on that. They entered auto lending as well. I believe that was about 6 months ago. Agora is the big partner there, but they have others, of course. And they've also are getting into first lien instead of just second lien with the HELOCs. So I think any lending category you look at, realistically, they will get into at some point. The if you follow Mike Cagney on X, like he'll throw out some stuff where they're just like thinking and postulating and looking at, but they also know that they have to caution against trying to take on too much all at the same time. And a couple of those ideas that they're throwing out, like including like getting into the IPO space, I was like, okay, you're maybe doing a little bit too much all at once. Let some of these build out and ramp. But yeah, here is some of these individual platforms. So let me blow that up just a little bit. So FIGR Connect volume up here, you can just see the ridiculous growth, 132%. This is their consumer loan marketplace. So if you see a CLM abbreviation, that's what it's referring to. Let me remove my head from there. Here's the ecosystem and tech fees itself. This is, again, this asset light platform revenue. It's a relatively small number still, but you can see how it's ramping and growing. And again, when they're onboarding things like 100 partners in a quarter, and it takes about 6 months to really ramp to about 200% volume. Like people that use this platform, both from the business standpoint and individual users, they're like, man, I got to use more of that. It's a great thing when you have a product that's so compelling like that. Adjusted EBITDA is looking very good as well. Yeah, the rule of 150. So rule of 140 or rule of 40 really. I shouldn't say 140. Rule of 40 is of course typical for SaaS names initially. A lot of fintechs, including FIGR, have moved into the rule of 40 and using it. And I think it's a good measure. And the idea basically is if you're under the rule of 40, maybe you're brand new, there's something scaling, but it's not great. You want to be over that number. We've kind of gotten spoiled by some ridiculous companies like Robinhood and especially like Palantir and also Nvidia of just absolutely crushing the rule of 40. But when you're at 150, you are doing absolutely something right. A big part of that is the adjusted EBITDA margin and of course the revenue growth. That's the two things right there. So building momentum across marketplace categories. Here's those brand new questions or brand new offerings that you can see. 3 times volume on first lean volume category year over year. But again, these are off of very, very small numbers. It's just a good start. Small business growth, the lending growth here, 57%. The partners as well. They launched small business pools on Democratized Prime, which is a double-sided marketplace. So like individuals like myself can just download the wallet and start actually even lending or buying. Like it's a neat little platform. And then third-party borrowing live is up 23x. But again, that's off of such a small number. Don't read too much into that number from Democratized Prime. All right, this looks like a new slide. Dual lanes of growth, substantial volume growth is being driven by new partners, onboarding existing partners, doing more with us. If you have a great product, that's a nice thing is once people onboard, once they use their product, they make a lot of money from you. So they're like, hey, why don't we just do more of this? And so you can see this ridiculous growth here. Now, a lot of this is, so you can see new partners, same partner, and retained base. The retained base itself still looks quite good. You can see that the way that these same partners have expanded. And then this is the brand new volume. I like that they broke that out. That's really, really helpful. So their growth right here is coming from a combination of the same people using it even more and the new partners as well. And that's going to continue. FIGR factor is shifting partners into market winners. Forward-thinking partners are leaning to FIGR and growing their business. So again, yeah, they're so efficient in what they do, and they've demonstrated this time and time again. A lot of companies are just like, why do we even try to build our own platform? Why not just use these guys? Now, there's some that are going to do it anyway, regardless, just because they want the efficiencies or they think that they can do it better. But yeah, there's tremendous growth here because of that. Consistent underwriting discipline. So again, they do underwrite some of their own loans as well. So they have both the marketplace and their own underwriting. And so you can see, and I'm glad that they break this out. A lot of new slides. They're doing it. I like this. Weighted average FICO at origination, you can see at 751, so quite robust. It is down a little bit from the peak of last quarter, but actually this is over the annual basis. So it's pretty constant there. And then the consumer loan total volume at origination is down just a little bit. Delinquency status by vintage, that is looking quite well as well. Like one of the themes of this earnings call is all these banks and lenders are talking about the health of the consumer and of course what's happening with their loan vintages. all those numbers look really, really good. And is everything perfect in the macro? No, obviously not. Let me take a pause here and look at some of these questions. Corey is your largest holding as of yesterday. Yeah, mine went north of 20% in my portfolio. So I did sell a few shares. It wasn't a lot, but I'm like, I have very little cash. There's probably going to be a pullback at some point. I need some money just to make sure that I can buy the dip a little bit. And let's see here. Another Corey shareholder waiting for 140, 150 range. Yeah, I think we probably get there this year. But long term, it's pretty easy to see the trajectory of these guys. Do you think that FIGR has the same risk as SoFi? Not really. I think with FIGR, like a big part of it. So SoFi does now have, because of the loan platform business, this asset light revenue as well. It's a little bit different because SoFi is still doing all the origination. FIGR can do that, but they don't have to. They can securitize, but they don't have to. And so a lot of what they've built, they have some of their own loans. There are some similar risk for all lenders across the board because they are doing their own lending. There's always going to be something like that. But for the most part, like they're really, really shifting fully into this platform itself, doing a lot of lending through that, and that just asset light. There's little risk there. And especially if you look at what's currently happening with rates, is there an environment like realistically, are we going to go to the expectation of like 4 rate hikes? I don't think so, especially given that CPI. It seems like things, even with Iran, are just messy and ugly, and that can drive inflation, which can, of course, drive rate hikes. But realistically, like, how much more are we looking at versus these workarounds that are being built in the region that hopefully won't have to be something long term? Um, does the Clarity Act have any value for FIGR, or will be it just business as usual for them? It's mostly business as usual for them, just because their yields is, again, it was the first SEC registered stable coin, and because they are a lender with the license, they're able to offer that yield natively. They don't have to worry about that yield loophole, which was, one of those products of the Genius Act, and actually even before being closed, they would actually benefit from that. So. I don't think that they're hoping for that, much like SoFi isn't hoping for that, but they're both positioned very similarly with their stablecoin, where if that happens, then their stablecoin becomes even more unique because it can offer that yield natively versus like the USDCs, they all of a sudden can't. Maybe internationally they can, but at least here in the United States, they would be close to that. So, but I think overall, like the other factor too is I've asked this question to a couple of other people that are in the space, including C-suite folks, on are there those that are waiting as far as businesses and as far as partners of scaling until they figure out what that Clarity Act looks like? And the answer that I'm getting time and time again is not really. They do think it might accelerate some once Clarity Act does pass, just because people understand, okay, this is what the regulatory environment looks like, and then they're even more confident. But for the most part, I think it's just mostly business as usual, depending on, of course, the flavor of the Clarity Act. SoFi and FIGR need low interest environments as tailwinds. I wouldn't say need. I mean, okay, so SoFi is growing 40% year over year. So it doesn't sound like they need it, but they would benefit from it immensely, Joshua. FIGR is growing at over 100% year over year and probably can for the next year to year and a half. So do they need the low interest rate environments? No. If we get those, let's say we go from where we're currently expecting. Let me actually pull that up right quick because I didn't look at next year. I'm actually very curious if that's shifted at all. So we don't go all the way out into December yet, but October 2027, the current environment is looking at more likely than not 1 rate hike overall. So that's not bad. But let's say we go from this into an environment where we're looking at 2 rate cuts between now and next October. Those will be tremendous tailwinds. All the lenders, including SoFi and FIGR, they're going to do really well. So need is the wrong word there, but you have the right idea that they hugely benefit from that as well. Um, yeah, Meta. I talked about that yesterday on X with somebody who is a Meta shareholder. I'm not, other than just the stock paper draft and everything. But the lawsuits is an overhang. Really, I think with Meta, it was one of those things where they didn't handle the earnings call very well. All the other hyperscalers did a really good job of talking about the ROI. The ROI is not really there for Meta. They didn't have as clear of a picture as far as how they would deliver that. It wasn't a bad earnings by any means. I do think that the market is disrespecting Meta wrongly, but yeah, how can the stock be down after this report? Yeah, the only thing that I really saw, was the one very small miss on. Let's see, what was that? Adjust no Operating income was down just a tiny fraction, and the take rate fell by 0.1%. But these should have been expected, so not really sure who is looking at this and said, "Oh man, these are terrible numbers," because this is a pretty phenomenal beat. Uh, yeah, sometimes these names it takes time. Even if the business is doing great, just like Figure is. Sometimes the stock doesn't move at all. And so that's one of the benefits, by the way, of not necessarily going into like options. If you do leaps, make sure that you're being very conservative on time frames. But if you own shares, I've seen this with many, many other companies where I'm buying the shares hand over fist, and the market's like, this name is worthless, and I'm not going to do anything with it. And all of a sudden, something changes in that narrative. The market gets it, and that stock absolutely starts flying as well. If blockchain go down, that will follow is a problem. I'm not sure what you're saying there, Michael. So these guys have the Provenance blockchain. It's their own blockchain that they run and operate. That doesn't go down. So I'm not quite sure um, what would happen, but that's what helps empower a lot of these efficiencies. How are you thinking about position sizing for Figure in relation to your other holdings? It's well, boy, I'd actually have to look because my portfolio is so ridiculously volatile with the names that I'm in right now. So, uh, 2.5 weeks ago, all the gains from the year faded, and I was actually down a little bit year to date. I was like, man, I didn't see that coming, and now I'm up very nicely year to date because I think from that bottom, my portfolio is up something like 30% in like 2.5 weeks, which is I don't have that much leverage, guys. But I mean, CoreWeave is a huge holding, and you could see it. It went from a little bit under $60 to where it's at right now in no time at all. It's kind of crazy environment. So let's see here. Why did Figure have a very low quarter-over-quarter market volume growth the past couple of quarters before the big jump this quarter? Um, Yeah, that's a fair question. A lot of it has to do with the timing cycle of the onboarding of the partners. And so if we look at, let me actually pull this up because they don't have the KPI numbers yet on fiscal, but we can see the partner stuff. Oops, let me reshare. Okay, so here are the total active partners, and we'll just do it in bar chart form. And yeah, I'm quarterly. You can see how these have ramped immensely, but the percentage growth looks nice, but the actual amount growth here is not really that substantial. Now we've taken a massive leap forward from this 387 number, adding about 100 new partners, which is awesome. But it takes about 6 months for those to fully scale out into that increased volume. And so you can kind of think about it as this being, I wouldn't put complete weight on this, but as a leading indicator of what that future growth volume will be, there's going to be more than you would expect because of the Aguara acquisition, which will land in the second half. But this huge increase here in partners that they announced last quarter that got me really excited. This was also a nice step up as well. But some of it too is the categories that they ended up coming out with as well. So, like if you look at overall Connect volume and everything, they were just building so much, doing so much, but a lot of it was brand new, and that's why you have things in the Figure slide deck where they're talking about growing 27 times. Here it is. Yeah. Oh, wrong tab. Tuning in from Greece. That's awesome. Apart from Figure topic, your opinion about cyber stocks are overvalued at 90 times forward price to earnings, or AI boom price justifying the price with multiple contraction. Yeah, the market is forward looking and forward looking for a reason. So if there's like any specific stocks, but you're referring to cybersecurity, on cybersecurity, and I need to do, I might do like a members only. There's a bunch of you guys now. I've talked about it on live, so you're still getting the information elsewhere, but one where I just put all of it right there together. I don't own Cloudflare. It's probably the only name where I'm like, I would love to own it, but it trades at a premium. Now, they are in the cybersecurity bucket, but I'm not talking about them so much for that. Matthew Prince, like the CEO, he is fantastic to follow. The reason why is Cloudflare sees 20% of the internet traffic run through them. So they have a great read as far as what's happening. And so they mentioned it was either in March or May that non-human traffic surpassed human traffic for the first time that they saw. That's not going backwards. All the agentic traffic that's happening, the LLMs and everything are fueling that. They have expectations that in the next 5 years, that could a thousandfold increase. Just think about that in terms of the impact on cybersecurity. I don't think that, I mean, it was the dumbest thing, and we all, I think almost everybody knew it was dumb when all SaaS was selling out off, including cybersecurity early in the year. I'm like, there's a much larger need with agents and the agentic traffic and the LLMs, and I think that we're underrepresenting that. So I wouldn't necessarily say that cybersecurity stocks are undervalued right now, but I don't think that they're like extremely way too high if you have long-term horizons. Doesn't mean that they might not retrace though. Um, the take rate is down because they have a different mix. Yes. Yeah, the mix shift is what they've talked about. First liens, of course, 3.5, I think, is what they settle at. I'm sure that they will be asked by analysts again, and they'll re-rate that as well. Reiterate. CoreWeave has grown to 55% of your portfolio. Yeah, there's nothing wrong with like sizing according to where your conviction's at. 55%, I mean, I own 20% of my portfolio. That's a huge conviction for me. So 55%, I took a little bit of gains off the table, not much, but yeah, regardless. Take rate is down to 3.6%, not strong enough guidance for quarter three. Guidance looked pretty good to me, but yeah, the take rate, that should have been expected. But yeah, regardless, they will talk about it. That's a one kind of weak number. Yeah, we're going to listen to this. It's going to be here in 29 minutes. We'll listen to it live. So yeah, I'll be here shortly after that, probably before the market opens. I might stay until the market open and go. What price would you say air price action? I was thinking of trimming a little bit when it was overextended. Would you say there's much upside in the coming upcoming months? All of it depends on, well, it depends on two things. One is, of course, the general macro as it relates to the AI supply chain. So if you think it's going to be favorable, yeah, there's probably future upside, even apart from earnings and apart from contract announcements. They with Air, they're so small that everything can change with just one announcement. So they've been attempting to and engaged with all these other hyperscalers. They had, of course, their contract announcement for 22 million for hyperscalers yesterday for their lead hyperscaler customer for the wafer level burn-in all the way up. 22 million doesn't sound like a lot, but look at their revenue last year. Look at all the other effective backlog that they have. So I would say it's probably the stock is a bit ahead of itself. If you've not taken gains, there's nothing wrong with taking gains. I'm not giving you financial advice, but don't feel like you're selling out. I've taken gains. So I put a price target on Air coming into the year at 70. I feel like they've executed ahead of that. So, if I move my price targets in intra-year, I'd say, $100 a share is not ridiculous at all. 140 is a little bit pricey, 130 as well. But that doesn't mean I'm selling everything. But even though I had that price target, I started taking gains at 55 just because it was like, hey, this is at the time, it was a very, very small market cap. It still is pretty small. And I was up so much, I'm like, let me take a little bit off the table and size it according to where it should be. I'm going to take a couple more quick questions. We're going to jump on into the rest of that slide deck. There's another 5 slides there. You may have touched on this already just as I joined, but you see the Iron news. Should be another boost in general. I didn't. Let me see here what's circulating. Oh, oh, that's interesting. Okay. Yeah, let me throw that up here. Remove this. Thank you for, sharing that. Yeah, we have data center monthly that we're going to do here tonight. Jose and Nate, of course, are joining me. Jose owns both Iron and also CoreWeave. Nate just mostly Nebius. He owns some CoreWeave as well. I own mostly CoreWeave, one share of Nebius just for fun, but I like all of them. So yeah, the Iron says Microsoft has accepted Horizon One, the first four 50-megawatt AI cloud deployments under its 5-year, 9.7 billion contract. And yeah, of course, it's running NVIDIA projects. So Horizon 2 and 4 are due later this year. So yeah, that's good news. There were rumors on this as of last week. If you don't follow, well, let me pull him up here. I'll give him a shout out. Jim Liu, I mean, his conviction on IREN. Like, if you don't follow him and you're an IREN shareholder or you're interested, I don't know what you're doing, but he's very good in the AI space in general. He'll see some things and think about it differently than I do. By the way, he is now bullish on Nebius as well. So it's one of those spaces where pick your flavor, pick your preference. It's an exciting space, but these are extremely volatile names as well. Let me go ahead and jump back into that slide deck. We have about 25 minutes before the earnings call, and we'll listen to that live together here. Okay, strong capital market execution. And so you can see here our continued execution continues to strengthen along with increased frequency and larger deals. And so here's the number of deals as well. It looks solid, 120 basis points tighter execution versus the average there of that spread. Consumer loan marketplace there, this is the guidance. So yeah, somebody had said that the guidance looks weak. When you're guiding at 102% year over year at the midpoint, and by the way, they have a history of sandbagging on their own guidance as well. And then analysts, they keep beating because analysts also are guiding a little bit conservatively. So they'll probably come closer to the higher end of that, maybe even exceed the higher end of that as well. We have some reads because they do give the preliminary monthly data. They also give weekly data as well on what's happening with the marketplace volumes. But yeah, regardless, this is good as well. Adjusted EBITDA margin, the midpoint is 60%. And then yeah, here's some of those numbers that the yields funding cost is one of those big things that looks like a cost. Oh, let me blow that up a little bit more so you can see it. That looks like a cost. It is, you have to account for it, but all that is basically the stable coin is not just money that they create out of thin air. It's backed one for one by dollars. So that can look, oh man, look how bad that is. No, it's because their stablecoin product is growing. So that's great. So yeah, adjusted net revenue is just up immensely. And I think that they'll continue to do that for quite a while. Stock-based compensation, it's just like any tech company here in the United States. They're going to offer that. Net income margin, I mean, it looks good. So I'm not quite sure what the market is seeing that it doesn't like. Let me see where the stock is. If it's still down, it wouldn't surprise me. Just down 1.53%. Really good earnings, much like VG earnings. Venture Global, really, really good earnings. They had the triple beat as well. And the market's like, nope, we're going to sell this off. Some of it, of course, related to the pricing on the TTF on the natural gas. Okay. And good morning, Ricardo. Thanks for being here. Yeah, yeah. What the fellow that I was talking to yesterday is the same thing that he feels like I don't think it's a mistake to reduce if it's. I think it's a mistake if it's only just because of the price action, unless it's like it's going to help you sleep at night or there's something you're more bullish in. But if you're like, hey, the what I pictured that they'd be executing on is not nearly as good, it's okay to make a pivot. I have looked at Rubric in the past, but I've not kept up with it. I'd say a little bit over a year ago, I was interested in it. The hard thing for me with cybersecurity, and this is one of the benefits of ETFs, is if there's a space, like let me throw out biotech. Probably not a lot of us understand biotech very well at all, but I'm like, okay, people sleep on sectors for a little while, but I think it was 2021, it was the top performing sector in space in the market. And maybe it might have been 2020 actually. And it's been terrible really until late last year and early this year. A lot of biotech names. We've seen Accelera, we've seen Intellia and so forth do really, really well. I don't understand biotech at all. And so if I wanted to invest in that, I might just do something like ARKG. There's a couple other funds as well. Cybersecurity is like that with me. I understand it a little better than biotech. Mostly I understand the need and like the different types there, but like qualitatively, I don't have a great way of understanding it other than just looking at the numbers and seeing what other people have said. So Rubrik, it is an interesting cybersecurity play. It doesn't seem as overvalued as some of the other names too. Cerberus, I looked at the headline numbers. It looked fine. It looked good. I saw the stock price action, and I didn't have time yesterday and then this morning to look into that. So if anyone is knowing what the market did not like about that report, I'd love to know. They're one. I mentioned this yesterday too, and I will go back after earnings season with some of these companies. They're one of those that's on the list. Not because I'm necessarily looking at investing in that, but they're doing something very differently than the rest of the market. And I really like, if I'm able to, listen to see what's happening in that space and see if the market's shifting that direction, how those products are looking at. And sometimes you can get some alpha through that. So I've not gone through the earnings call yet. I won't have time probably until after NVIDIA earnings. So give me a couple of weeks, but in September, I hope to jump in. I will look and see what other people said. Short term wise, what's your estimated downside risk if we get a post earnings pullback? And what price level do you see as ideal for heavy accumulation? For me personally, I've been accumulating this range. I think under 35, it is a very attractive buy for the long term. If you see $25 a share, I think it's a screaming buy at that point. That doesn't mean that I expect it to immediately rebound like the Coreys and the Nebuses when they have these big pullbacks. But I think next year people will be upset with themselves if they didn't end up buying more. They are executing very, very well. Downside risk, I mean, they're profitable. Things are growing really phenomenally well. Barring something that shifts and breaks in the macro, um, it's hard to see them get under 25 and stay there. Of course, I didn't think that they'd be under 30 for long either, so I could be wrong on that. Hims earnings I did look through, yes. It's one of those companies again where I will be paying attention to that. I'm rooting for them. I saw better opportunities, and so I ended up selling Hims at a lower point than where it's at right now today, and buying a ton of Nebius because I'm like Nebius was a screaming buy, and it ended up being because it was trading at 70. I think my average was like $80 a share looking at where it's at today. So I'm not looking at legging back in. A big part of what's the overhang with HIMS and that there is specifically the legal stuff. And you can look at, I forget the term for it on there. I have a post on X where I pulled that up from their SEC website, but it's the legal contingencies. And so basically, they know, and they talk about it in their 10Q filing. They didn't touch much on it in the call, that there's real risk there. The lawsuit risk from a lot of these has gone down, especially Novo Nordisk, but there's still a lot there. And it's one of those things that HIMS is always going to face. But I think that they took on a little bit more risk in the way that they're operating than in the past. It's one of the reasons why I got out of HIMS as well. Yeah, Rubrik, great company, expensive stock. That's most cybersecurity stocks. So earnings came out already. The earnings call starts here in 18 minutes. So we'll jump in on that when it comes to time. Biotech is a bubble, no income. Biotech isn't. Again, it's not a space it's not like on an individual area. It's something I understand. It's weird though. It's kind of like, a lot of the energy plays like Venture Global, like the way that the energy plays usually trade is very different to the rest of the market and what people look for, also very different as well. Biotech is no profitability at all. And then they have these individual products that they're working through with the FDA, and they're doing all sorts of different tests. And there's different phases as well with these clinical trials. And so there'll be no news, no anything, just a lot of speculation. And then when they announced, like Accelera did on Monday, if it's successful and they're like, hey, we're on to the next phase and everything looks really, really good, the market loves that and it goes up like crazy. And if it's not, it just tanks. And so there's people that are just biotech investors. They understand the space, they understand the molecules, they understand what's happening there, and so they can usually separate the wheat from the chaff. And so yeah, it's not really a bubble. It's just it's extreme. So if you invest in like 10 biotech names, nine of them might go to zero on you, and one of them does like a 50x. It's crazy. It's not for me. Why are we talking about under 30? Well, FIGR was under 30, really until that 10% rise yesterday. So I don't expect it to be there, forever, but it will be for a little while. Given FIGR's rate sensitivity in the modern Fannie Mae thesis, what is the biggest friction point holding traditional originators back from using FIGR over traditional channels right now? I think there's a couple of things. So it's a little different, but it's similar to what happened when they first began to exist and they were doing home equity line of credits. That they'd go to these big banks and they'd say, hey, this is what we're doing. They're like, hey, that's really neat. We need to see proof of concept. So FIGR had to take on that themselves and do that, be the originator. And then they began to have partners that said, oh man, this is actually working. It's not just a white paper, essentially. It's a real product. Let's do that. That because they've already demonstrated it in second lien, it's not a big leap to the first lien. The other part too is uh, it's a slow space. It's a really, really slow space. The mortgage market absolutely is. The realtor, one of the realtors that I was talking to, um, what was last month? I was very curious about it. I was like, how are things going for you? What are you seeing? Now, real estate is a local market as well, so Houston might be a little bit different than other areas, but yeah, it's really slow. Things do move and sell, but HELOCs, on the other hand, that's been really, really good because you have people that bought during COVID. The price has risen ridiculously. The rates have risen as well. They don't want to get rid of those low rates. And so, what do they do if they need to unlock some equity? Home equity line of credit. So it's been a great environment for that. So I think it's mostly the environment, the rate sensitivity as well. But the traditional originators, I think they need to see more proof of concept, but that's going to happen a lot faster than it did the first time with Figure. And then well, the other thing too, like if you're a SoFi shareholder, you'll understand because when they talk about the tech platform business, these traditional banks, they're used to doing things a certain way, and they're like, hey, this is just the way we do that. This is the efficiency we're used to. This is the cadence we're used to. This is what we expect to earn. And not all are dinosaurs, but a lot of them they're slow to adopt a change unless they're forced to. And so I don't think this is one where they're going to be forced to necessarily, rather than it takes some time to make decisions, and they're just getting it. Now, the other factor too is with the Kiavi acquisition, that is a huge driver, specifically of volume. That'll further demonstrate the proof of concept, what's happening here with Figure as well. And so I think that next year we're going to see a tremendous growth, not just in terms of percentage for these guys, but it does take time to build out. What price would you trim CoreWeave? I took some profits yesterday. I took a few shares off the table. It's a long-term hold for me, and so I have a combination of leaps for 120 strike, which are up, by the way, massively. I did have some short-term options that I sold. They were up like 40% before earnings because I'm like short-term stuff, good enough for a screenshot, good enough to take profit was my mindset. And I wanted a little bit more cash this earnings season anyway. But yeah, the shares, I don't have a price to sell them at. The growth that's happening there for the demand for data centers and inference is just absolutely ridiculous. The next good news for SoFi, I mean rates, just what happened with CPI. If rates, they look at their guidance, what they issued, and they're assuming two rate hikes along with pretty much everybody else versus initially going this year two rate cuts. If we don't get any rate hikes at all, man, they are set up very, very nicely as well. Yeah, Cisco's not a name I pull to pay attention to, but that's been the markets have been doing that. Not of course the first quarter for this, where you see like even with Figure here today, ridiculous beats, and the market sells it off. It's one of the reasons why I usually don't play with very rare exceptions. I think the rare exception is like once every few years earnings. I just don't make an earnings bet, even if I know these numbers are going to be great and the market's not looking for that. It's hard to predict that initial stock reaction, even if it's great. And we've also seen the theme of if they are really good numbers and the market or the stock is not too far ahead of itself, sometimes as it digests the numbers, we could see that run like the next week after as well. Uh, One of these days, one of the big five originators that are over 10% of the revenue will pull out, and then this thing takes. I don't know why you'd say that. Who else is delivering the efficiencies that these guys are? I'd say the concentration risk with them onboarding 100 new partners this quarter, which yes, they're all of them together are not the same size as one of the big five, but the concentration risk goes down over time, not up. So I think that that's incorrect. Now, if there's something that you're seeing like, hey, there's a real reason for concern of that, I'd love to hear it, but I just don't expect that. PPI coming up soon. Yeah, if you guys see that or when you see that, let me know. That'll also be something that will impact Figure as well as a lot of other stocks that we're sharing here today. Bought and sold CoreWeave in 2 weeks for 30%. Nothing wrong with taking a profit. If you're like, hey, I want to hold this long term, but all of a sudden it's worth 30% more and you see other opportunities, that's okay. I did that with Nebius after like 80% gains. Um, that's okay. It doesn't mean you don't believe in further upside. Dell is going crazy. Let me let me pull that up here. Did they report today? Yeah, it's a pretty wild chart. It's up 2.9%. Of course, it was up 10% yesterday. AI supply chain stuff was at an all-time high. Yeah, all-time high for Dell. So congrats for any shareholders that are there. That's neat. I loved the Dell's support of the Trump accounts and saying, hey, take some of our money and use it for these young kids that are being born, put it in their accounts. That's awesome. We can see that you're enjoying what you do, and that's fun. But what's your magic number when you say is enough is enough? So I operate by the rule of 4% as far as retirement. And so for me, that's $3 million. $3 million is $120,000 per year. Rule of 4%, the benefit of that is you're accounting for inflation and you're also accounting for the possibility of a longer lifespan. I think with AI, how it's being used, and a lot of other stuff too, like GLPs, and there's going to be better treatment with AI and robotics on a lot of medical stuff. I think the lifespan of humans is going to increase quite nicely, not decrease. And so if people are expecting like, hey, I'm going to live to 82 and kick the bucket, and you're blowing through your retirement account expecting that, there might be some pain ahead. So it's better to have a conservative target. 120,000 sounds, I mean, it for some it might not sound like a lot, but I also don't know that I'll be living in the United States at that point in retirement. It's one of those things I've talked about with family and with friends. There's a lot of attractive, wonderful places to live in the world. Love the United States, so I wouldn't be leaving for that reason. But I mean, there's nothing wrong with going to the Mediterranean and saying, hey, this area is a great place to live in. A lot of history, a lot of culture, a lot of food, a lot of it's very cheap cost of living as well. So we'll have to see. Now that quarter two smashed estimates, does that this be change your long-term valuation model for 2027? I don't have one for 2027. I have some thoughts like long-term that this could be a 10 or 20x. So I just say that we are on track for that. But yeah, I love to see them absolutely smash the earnings, especially the EPS number there. All of us should have bought them. They're absolutely killing it. Thank you, Roy. Bought CoreWeave during the dip. Easiest money made with less than a month. These things are it's so ridiculous how fast the narrative changes, and that's really what drives stocks over the short term. We've seen that with Nebius before. We've seen that with CoreWeave. We'll see that with Iron. I'm not an Iron shareholder, but I was thinking like, man, before earnings, do I want to maybe just do a short term, not a short term, but just a small position in Iron? It's not my favorite of the three names, but it's been disrespected by the market for a while as well. So yeah, when you see it doesn't happen all the time, it doesn't happen often, but usually there will be a few names each year where I'll be like, okay, the market is just being ridiculous on this. I don't know when the bleeding will stop. I never thought CoreWeave would go under $60 a share. I didn't. I was like, there's no way it would. It did briefly. I didn't think it would go much below 80 for long. It did, of course, not for long, and here we are. So it doesn't mean, by the way, we can't retrace. Iran is 46 today. Maybe so. Yeah, yeah, Greece, I would love to. I actually, I know some Koine Greek. I know just a little bit of modern Greek. I know that they're not the same. But yeah, I see from your name there with the alphabet that you have a Greek name. So Alexandros Zafiropoulos. I probably butchered your last name, but Alexandros. So Alexander, thank you. Microsoft accepted their Horizon One for Iron. Yep, saw that. I I don't follow them actively. eToro is interesting. I think it's cheap. The hard thing is like I don't buy names just because I think that they're cheap. By the way, earnings call starts here in about 6 minutes. So right after this, let me go ahead and pull that up. They might have the music started already, but I don't want to miss the beginning of that. eToro is if I was going to invest in a brokerage beyond Robinhood, and of course I own SoFi as well, but like more of a pure brokerage, eToro, maybe IBKR. Like IBKR is doing well, Schwab's doing well, all these guys are. Like it's a great environment to be a brokerage, but it probably would be eToro. I like the leadership, I like what they've done, but I also think it's not as high of a quality a name as Robinhood. So yeah, I did not look if they've had earnings this quarter at what those have done. So if there was something that you saw or you really liked or you didn't like. Would love to hear that as well. Let me go ahead and pull up their page though, just to make sure that I'm ready to go with the earnings call itself, which will start here in 6 minutes. Yeah, they don't have the link out yet. Click here for webcast. There we go. Ah, I need to fill this out too. 1 second, guys. And this here. Yeah, we just have the music going on right now, as to be expected. So when that changes, we'll switch over to that, and I will mute myself and I'll. I think I have ads running. Maybe I don't. Yeah, it looks like I do. I'll pause ads at that point. So um, both Coherent and Cerberus sold off. I wonder if it's a good opportunity right now. Cerberus is one that, yeah, I'm going to for sure go back once we get past earnings season and go through that earnings call if I don't have a chance before. It's a really fascinating company. Coherent, I don't know nearly as well, but yeah, I can't tell you if they're good opportunities or not. I don't know them well enough. But Cerberus, they're fascinating. So we'll have to see. I don't know I don't know what the market is not seeing there. I saw the headline numbers. Things looked good. I didn't see anything that the market is keying off of. But I mean, sometimes case in point here today, Figure Technologies. It's one of those things where the market can oftentimes just be so myopic where it's just looking at this one thing and nothing else matters, or that it just doesn't care about that company at all. It's focused on others as well. That doesn't mean that, by the way, it lasts forever. Zscaler versus Rubrik, not sure. Cybersecurity is so far out of my domain. Um, when I was just doing a little bit of due diligence, I liked Rubrik a little bit better, but yeah, I'm so much of a novice there. Take that with a grain of salt. Of course, CrowdStrike, very fine company, Palo Alto as well, but they're very expensive. The one cybersecurity name where I would buy like instantly and immediately, but it's not, it's a little different than a lot of the other offerings because is Cloudflare, and what they do is far beyond that. Uh, I'll at some point here, maybe in the next couple of weeks, put out one of the member only videos where I'll talk about why I find it so ridiculously fascinating and what price level I'd actually be comfortable owning. It's too expensive right now for me, even though I long term they're positioned so well to take advantage of what's happening in the space with all the agentic traffic and also of course cybersecurity needs. There's really three big growth levers. Let's see, Figure is down about 1.97%, so it's at $30.08. We'll see how it reacts during earnings call. I've not noticed before that during earnings call that it really shifts the direction of the stock, but I do think, of course, PPI is one of those things that could absolutely change that perception. Let me see. Is PPI is out, I think, also at the same time. Yeah, in 2 minutes. So when you guys see PPI, the earnings call might have been started. I'll throw that up, but just put it in the comments if you guys don't mind. Morning, Broccoli Bob. Good to see you. Sold puts at 27 and calls for 34. Yeah, the IV is quite nice, especially with earnings, but even outside of that, it's been nice selling options. For Figure this time, I didn't even sell any covered calls. They're all just shares. And then I have some leaps as well. I was like, I don't know how the market will react. I feel like it's pretty undervalued. And I tend to not sell much in the way of covered calls if I want to be in the stock for a long term. You have to hold one stock for 10 years. What would it be? Probably Nvidia. It's hard to look at Nvidia and be like, hey, it's not expensive right now. I think it's undervalued actually. It will resume cyclicality at some point, but 10 years, cyclicality doesn't really matter, just execution. They are still in the epicenter. What's happening with AI? AI is not going to be like a 3 or 5 year fad. 10 years out, we'll still be building. We'll still need a lot more. Um, One of the most fascinating comments this whole earnings season was kind of related to NVIDIA. Well, it was. It was from CoreWeave, and they talked about these A100s, which is an NVIDIA product from 2020 that still has immense value. It's the depreciation myth is done. It's over with. It should be. Bears continue to recycle it. Burry actually doubled down because of depreciation on Nebius, but they sold these A100s for somewhere around the initial price. There was comments on that CNBC interview from the CEO where they weren't giving a tremendous discount because of the age. And these at the end of 2029 will be 9-year-old GPUs. That's just insane. So part of that is just the quality of the NVIDIA product, but also the CUDA software as well. It's not just on spec white paper. It usually functions even better than expectations. And so, yeah, NVIDIA Palantir would probably be my second choice. It is not no longer cheap. It was getting to the point where it was cheap and undervalued. Yeah, earnings call should start here any minute now, and PPI should drop here in just a moment too. Yeah, I don't know Fastly at all, so I can't really say. Sorry, Rowan. It's just still hearing music on the earnings call, so we'll switch over once that is no longer going. But they should be starting here anytime now. Okay, they said it's about to begin, so let me remove this and let me share. Let me know if you guys can hear this.
At this time, all participants have been placed on a listen-only mode, and the floor will be open for your questions following the presentation. If you would like to ask a question at that time, please press star 1 on your telephone. If at any point your question has been answered, you may remove yourself from the queue by pressing star 2. To get to as many questions as time permits, we kindly ask that you please limit yourself to one question and one follow-up. Additionally, so others can hear your questions clearly, we ask that you please pick up your handset for best sound quality. And lastly, today's call is being recorded. I would now like to turn the call over to Mr. Brian Michalewski, Head of Investor Relations. Please go ahead, sir.
Thank you. Good morning, and welcome to FIGR's second quarter 2026 earnings call. My name is Brian Michalewski, Head of Investor Relations here at FIGR. Joining me on today's call are Michael Tannenbaum, Chief Executive Officer, and McCreary Gill, our Chief Financial Officer. Before we get started, I'd like to note that in today's call we'll refer to certain non-GAAP measures. These measures have been reconciled to their GAAP equivalents in the earnings release we issued earlier this morning, as well as in the appendix to the supplemental slide presentation posted to our website. As a reminder, non-GAAP measures are not intended to be a substitute for GAAP results. I'll also highlight that certain comments made during today's call may be considered forward-looking statements under federal securities law. The company cautions you that forward-looking statements involve substantial risks and uncertainties, and a number of factors, many of which are beyond the company's control, can cause actual results, events, or circumstances to differ materially from those described in these statements. Please note the risk factors we've identified in our most recent 10-Q and other SEC filings. We are not undertaking any commitment to update these statements if conditions change, except as required by law. The recording of this conversation will be made available on our website following the conclusion of this call. Following the conclusion of the prepared remarks, we'll open the line for questions. And with that, I'll turn the call over to Michael Tannenbaum. Michael, please go ahead.
Thank you, Brian. Good morning, everyone, and thank you for joining today's call. FIGR delivered another great quarter as more and more partners see our vision for bringing the capital markets on-chain. As previewed in July, FIGR generated $4.3 billion of consumer loan marketplace volume, being the top end of our guidance by 4%, with 132% year-over-year growth. This was our strongest ever quarter, and we've seen continued strength in Q3, with application volumes on our platform surpassing 1 billion per week for the first time in early July. The continued rapid growth extends to our origination partner ecosystem as well. We now have 489 partners on our platform, up 102 from last quarter, with growth across all segments, including independent mortgage banks, servicers, depositories, and fintech SMB. Importantly, recently closed partners are ramping faster than we traditionally see, aided by our investments in AI-enabled onboarding processes, thereby proving the scalability of our model and the value we drive for partners. Overall, our flywheel is spinning faster, and our blockchain-based infrastructure and marketplace advantages are compounding. Prospects are hearing about the benefits of our disruptive capital marketplace and our liquidity that's soon approaching what they get from the likes of Fannie Mae. The volume is improving our execution and pricing, adding loan buyers, and in turn, attracting more prospects. The investor side of the marketplace is also building momentum with large demand. Our recent pre-funded securitization is a great example where investors committed to purchase the bonds on our platform before loans were originated, a testament to their confidence in the standardized nature of FIGR production. Investors continue to join the platform and appreciate our strong credit quality, the transparency and speed of our investor reporting, and the reduced third-party diligence costs characteristic of our platform. Not only do we have nearly 100% revenue growth, but we are accomplishing this with over 50% EBITDA margins. Our EBITDA margins were strong at 55% this quarter, reflecting the growth of the capital-light FIGR Connect marketplace and our ongoing commitment to capital discipline. We are continuing to make progress towards our medium-term goal of 60% margins through the growth of Connect and the operating leverage inherent in our business model. This growth and margin profile puts us at a rule of 150 in the rule of 40 investor framework. This quarter marked 2 years since the June 24 launch of our tokenized loan marketplace, FIGR Connect, which now represents 65% of our consumer loan marketplace volume, up from 56% last quarter. This is very material growth, especially considering that aggregate volume is growing 130% plus. That's 0 to 65 in just 2.0 years. Turns out, when you build a better highway on chain, capital moves at high speed. As a result, more of our growing volumes are generated off balance sheet, again, demonstrating the momentum of our partner flywheel. Growth in Connect has been broad-based, with both new partner additions and expanding wallet share with existing partners. In terms of new partners, our trend has been increasingly aggressive. At the time of our IPO, we had around 250 partners, which then was roughly 3 years after being in the B2B business. And recent quarters have been 307, then 387, and now 489 this quarter. One new partner in Q2 onboarded straight to FIGR Connect and has already become the largest or second largest partner we have, depending on the month. Importantly, most whale-sized new partners are going direct to Connect, which means lots of incremental volume is skipping the FIGR as intermediary phase. This gives us an updated line of sight to predict that FIGR Connect is likely to approach 70% of volume in the medium term, rather than our previous estimate of 60%. Each point of mix shift to Connect reduces balance sheet usage, increases fee-based economics, and builds towards our medium-term 60% EBITDA margin goal. We've said before that we're a company that does what we say. We don't just whale watch, we bring the whales and we bring them into FIGR Connect day one. Take rate for the quarter was 3.6%, towards the low end of our guided range. We know take rate is an area of focus for investors, so I'd like to dedicate some time to addressing the contributing factors. For FIGR, take rate is an output of our strategic focus on accelerating our growth flywheel, rather than a metric we manage to. The results I've just shared in terms of volumes, partner network expansion, migration of channel mix towards FIGR Connect, and our adjusted EBITDA performance all demonstrate strong execution towards that objective. The take rate performance reflects this in a few ways. First, FIGR Connect has the lowest take rate of our 3 channels, although with strong contribution margin and the least capital intensity. We now have our largest partners going direct to FIGR Connect, which is a favorable dynamic to our business, although at the trade-off of take rate, and was not a dynamic we anticipated to accelerate this quickly when we gave the initial take rate range. Second, interest rates rose meaningfully in the quarter, which hurts our gain on sale and therefore impacts take rate. And third, we've previously mentioned that first lien loans typically have a lower take rate, and this quarter we saw a 3x growth year over year in first lien volume, although at a flattish mix quarter over quarter. As we expand our first lien origination volumes, it's likely to be a modest headwind to this metric over time. As we're nearly midway through Q3 today, our expectation is that the combination of these dynamics will keep the take rate at the bottom end of the guided range in the current quarter. Stepping back, when we set pricing with our customers, we focus on contribution margin, which includes operations and support costs and therefore better reflects our total earnings power for each dollar of marketplace revenue. This strategy is working, and this is the first quarter in which ecosystem fees are the largest line item on our P&L. This is consistent with our strategic focus on increasing our scale and the network effects from our flywheel, including asset classes to our marketplace. including adding asset classes to our marketplace. To that point, as Kiavi closes later this year, this will add a new dynamic to take rate. We're taking a closer look at this with the goal of giving you a better aligned way to measure our success as we build out the platform, with a focus on unit economic margins. More to come on that. FIGR Connect's growth is also leading to growth in Democratized Prime. These are two complementary layers of the same capital market stack, designed to serve our partners at every stage of their financing journey. First, FIGR Connect fast tracks our ability to launch new asset classes, adding auto, small business, and third-party home equity alongside our core HELOC product, without needing to build the origination engine ourselves. This expands our platform breadth, adds diversification, and attracts deeper capital supply. Second, that increased supply systematically drives down borrowing costs across the platform. Origination partners can leverage Democratized Prime as a flexible, modern warehouse facility to aggregate loans, benefiting from streamlined onboarding, significantly reduced operational friction, and rates that are closely competitive with legacy warehouse alternatives. Ultimately, growth in FIGR Connect fuels growth in Democratized Prime, making it a key value proposition for the broader Connect ecosystem. Given the growth and maturity of these dynamics, we're moving quickly to launch the next phase of this initiative, which includes long-term capital takeout via whole loan sales and securitizations for non-FIGR assets. Similarly, every partner we acquire is an upsell opportunity as we add more products like residential transition loans and DSCR with Kiavi. Our Kiavi acquisition will only serve to strengthen partner interest, as their market-leading RTL technology was previously not available as a private label marketplace offering, and many prospects have therefore expressed excitement. We have started to receive key regulatory approvals for the transaction and anticipate closing by the end of this year. This was a very attractive transaction with an under 4-year unlevered payback period and adds 40% to our volume, as well as $100 million of EBITDA. This was a great opportunity to use an inorganic approach to make our flywheel spin faster. The opportunity with Kiavi reflects an important point about fintech and the broader problem FIGR is solving. The residential transition loans are not agency eligible, and therefore companies like Kiavi use their advantages, underwriting, technology, and brand to benefit themselves. But that approach can only go so far. That's why we are so excited about our acquisition, because we can use their market-leading technology to develop liquidity and standardization for the space. By putting the marketplace first, we expand access to the advantage that made Kiavi the market leader, which is their post-renovation home loan valuation technology. And then we will make this technology the industry default, driving adoption at scale. We did this in HELOC. We're doing it with Demo Prime and other asset classes, and we'll do it with Kiavi as well. So I've shared a lot here on our growing business momentum. Now I'd like to dive in a little deeper on some of the details on the growing volumes our partners are bringing to us. 40% of our FIGR Connect volume growth was attributed to customers that have been with us for longer than 1 year. We have shared previously that over time, we see 100% growth in monthly volumes from existing partners that adopt Connect. And this quarter, we saw a number of existing partners migrate to Connect and expand volume accordingly. Our partner, New American Funding, is one such example, as they grew volume 80% in Q2 versus Q1. They onboarded onto FIGR Connect in early April. As interest rates have risen, end consumers are using their home equity balances to pay off higher interest rate consumer balances. Year to date, this has grown 4 percentage points of our total volume, reflecting the massive opportunity of the $35 trillion of home equity outstanding in the United States. Additionally, as these dynamics drive additional HELOC activity, our credit quality has improved and delinquency performance has remained low. These growth stories are part of a larger winning with winners trend that we see at FIGR, where market-leading companies, forward-thinking business leaders, and those with offensive strategies are leaning into FIGR and growing their businesses. There has been increased M&A in the mortgage space. Within the past few months, for example, Cross Country purchasing Two Harbors and Synergy One buying the retail business from New Res. In each of these cases, for example, you have an existing FIGR partner buying business from a non-FIGR partner, allowing us to in turn grow with our customers. Along similar lines, in 2025, 185 of our partners have been live on our platform, long enough for the full year of Home Mortgage Disclosure Act data to attribute their volume to us. We ran a counterfactual analysis to get a sense of how that volume compares to what they were doing pre-FIGR. We took each partner's HELOC activity from before they joined our platform and grew it forward at the rate the rest of the non-FIGR HELOC market grew over the same period. That's the baseline, what these partners would have produced had they continued at their prior trajectory. The result, our partners originated 2.6 times more HELOC volume in 2025 than their pre-FIGR baseline would predict. We call this the FIGR factor. Banks and credit unions are starting to take notice of this momentum. This is a focus area for us, and we move this into our recently launched new verticals go-to-market motion to give it extra attention. Banks are leaning into mortgage and home equity as they see the market opportunity, and also the potential capital relief from proposed changes to risk weightings. More recently, we've started to engage with large depositories that have big home equity businesses and are looking to leverage FIGR Connect as a way to manage their exposure and even buy Community Reinvestment Act eligible assets, meaning they can use FIGR Connect to source loans that meet their regulatory requirements to lend in certain zip codes. It sometimes gets lost on the market that depositories are big customers of Fannie Mae and Freddie Mac. Just because they have deposits does not mean they want to hold this fixed rate assets for 30 years. They want Connect. That same new verticals go-to-market motion includes our HELOC sold for business financing and via home improvement partners. These two businesses saw 470 million run rate volume as of June, with SMB growing 57% quarter over quarter at real scale. The partners originating home equity loans for business purpose are also generating opportunities for democratized prime, as the SMB market has very little capital market standardization, and we therefore launched our SMB pool officially in July. Before I close it out, I'll share a few examples of how important technologies in the market today, AI and blockchain, are making a difference in our marketplace. I'll start with AI. FIGR has a large task in that we must standardize multiple asset classes with disparate loan data and naming conventions that must be transformed into a standardized schema with a loan tape as an end product. In response, we built an AI adapter tool that creates this necessary standardization. For the Agora auto assets alone, the AI adapter accomplished in 5 weeks what would have been a several months long process and solves a huge partner pain point. This tool is also giving us the confidence to bring in Kiavi assets to our marketplace later this year. Similarly, we've been growing the use of stablecoin, yields in particular, as the payout infrastructure in FIGR Connect. Partners selling loans can get paid in yields days faster than the status quo with lower fees. Doing so has us projecting meaningful savings from wire fees and reconciliation time. Stablecoin allows for atomic settlement, which means asset ownership and conveyance can happen at the exact same time as money moves, reducing fraud and reconciliation. We are building the modern capital marketplace, and we continue to use cutting-edge technology to modernize our products. In summary, our Q2 results demonstrate once again that we are building on our first mover advantage and market leadership amidst a paradigm shift in the capital markets towards tokenization and standardization. This is reflected in the growth of FIGR Connect, our capital-light marketplace, huge partner acquisition momentum, and diversification of our partner base. The future is bright, the future is tokenized, and with that, I turn it over to Macrina.
Thank you, Michael, and good morning, everyone. This was a great quarter, growth across every part of the business. Consumer loan marketplace volume was $4.3 billion, up 132% year over year, from 1.8 billion and 4% above the top end of our guidance, our third consecutive quarter of triple-digit year-over-year growth. Adjusted net revenue was $218 million, up 95% year-over-year from $112 million. FIGR Connect volume grew to 65% of CLM volume, up from 42% a year ago, and up more than $2 billion year-over-year in absolute dollars. Overall partner-branded volume is now at 83% of CLM volume. One milestone worth reiterating, ecosystem and technology fees this quarter became our largest contributor to adjusted net revenue for the first time, directly reflecting the ongoing mix shift towards FIGR Connect, where we earn fee-based technology and ecosystem revenue. As Michael noted earlier, net take rate was 3.6% for this quarter, within the 3.5 to 4% range we discussed earlier in the year. Connect comes in at a lower take rate, but with high profitability to adjusted EBITDA, and is the most capital light of our business. This brings more fee-based economics and is the fastest growth driver for our business and revenue. Democratized Prime ended the quarter with a matched offers balance of $392 million, reflecting continued adoption following the expansion onto the Ethereum network this quarter, and our broader Solana real-world assets consortium initiatives adding distribution as well. We are also at $170 million of third-party assets on Democratized Prime as of last week, primarily from growth coming out of the Agora partnership announced earlier this year. We think this is an important number to watch going forward because it's the clearest signal we have that Democratized Prime is strengthening as a two-sided marketplace as part of our broader Connect value proposition. Every dollar of third-party demand that comes onto the platform is a dollar that's choosing FIGR's infrastructure over a traditional warehouse line. We expect this to keep building as we bring more partners onto the platform and as awareness of the capital availability and pricing advantage spreads across our existing partner base. Moving to GAAP profitability, net income was $87 million, up from $30 million a year ago, and approximately 190% increase. That included a $4.4 million tax benefit from excess benefits on continued stock option exercises, following a similar and larger benefit in Q1. We expect ongoing post-IPO equity activity to continue to create periodic tax benefits that may not be indicative of our normalized operational rate. Over the long run, we still believe an annual effective tax rate of 26% is appropriate. Adjusted EBITDA was $119 million, up 126% year over year from $53 million, with a margin of 55% versus 47% a year ago. This quarter included realized profit of $5.9 million from the sale of a business where we owned a minority interest. Margin excluding this gain would be approximately 52% and continued progress toward our medium-term 60% plus target. We continue to support Democratized Prime by deliberately retaining a portion of our loans on balance sheet longer than we normally do, approximately $360 million at quarter end, as I indicated last quarter to help build out the Democratized Prime marketplace. That had two effects. Both interest income and interest expense were higher, and adjusted EBITDA margin was reduced by approximately 1.7 points, since it added lower margin interest revenue to a larger denominator. As continued proof of operating leverage, operations and processing costs were at approximately 67 basis points of volume, down from roughly 79 basis points a year ago, even as we processed more than double the volume. We continue to invest in AI and automation in our operations process. For this quarter, I wanted to briefly touch on the strength and performance of FIGR and partner-originated loans that have followed FIGR's underwriting standards and utilize our loan origination system. Today, these loans are held by loan buyers or securitization vehicles. We sometimes get asked with growth at this pace whether we're opening up the credit box to get there. In short, we're not. If anything, the underwriting standards have gotten stronger. Weighted average FICO at origination has moved from 737 in 2020 to 756 year to date. And weighted average CLTV, which is combined loan to value, has come down over that time period to 62.1%. Average loan size has grown as well from 52,000 to 96,000, reflecting a shift toward larger, more established borrowers. Our execution in the capital markets has strengthened. Right alongside that, as we continue to show a track record on loan performance. AAA spreads on our FIGR HELOC securitization shelf have come in from roughly 255 basis points in 2023 to roughly 135 basis points year to date across 22 price deals, about 120 basis points tighter, while economics for note buyers have held up well. We've also grown the buyer base materially from approximately 30 buyers in 2023 to over 100 unique note buyers today, with 70% of them active across multiple deals. On performance, our securitized loan pools continue to perform well as a season, even as the securitized collateral base nearly doubled to $7.7 billion year over year. This reflects the same credit discipline we apply at origination. We also continue to see strong recovery behavior across the broader servicing portfolio. A meaningful share of loans that go delinquent cure back to current or pay off in full within 6 months, rather than continuing to deteriorate. That combination of disciplined underwriting and strong post-delinquency recovery is what gives us confidence in the book as it scales. Turning to our balance sheet, we ended the quarter with $1.44 billion in cash and cash equivalents, and subsequent to quarter end, on July 14th, we closed our rated $600 million senior notes offering at 8.5%, putting financing for the acquisition fully in place ahead of our expected Kiavi close in the second half. This debt transaction broadened our funding base and added a new source of liquidity for us to be able to tap into the future. We think this strongly demonstrates the maturity of the company, the quality of the franchise, and our ability to access capital in a disciplined way. We want to preserve balance sheet flexibility, avoid unnecessary equity dilution, and fund strategic opportunities in a way that supports long-term growth. This unsecured debt raise is not just to finance the Kiavi acquisition, but is an important step in expanding our capital toolkit as we continue to scale the business. Looking ahead, we are establishing our Q3 consumer loan marketplace volume guidance in the range of $4.8 to $5.2 billion. We're 1 month into the quarter, and July came in at $1.7 billion. July has historically been a good indicator for the full quarter, and applying the actual August and September historical pattern from both 2024 and 2025 to this July's result lands Q3 volume in a narrow band around $5 billion, the midpoint of the range we're guiding to today. We feel good about how the quarter is tracking. Our confidence here is really an extension of everything I walked through earlier. The partner ramp we're seeing on FIGR Connect isn't slowing down, and Kiavi is on track to close in the second half, which will layer in a potential additional growth vector we haven't reflected in this range yet. So when we say we feel good about the quarter, it's not just 1 month of data. It's that same set of drivers continuing to compound. Before we go to questions, I want to close with the same note I opened on. This was a genuinely strong quarter across every dimension we care about: volume, revenue, and margin, which none of it came at the expense of credit discipline. Connect is scaling even faster than we planned. Our balance sheet is stronger and more diversified than it's ever been, and we're heading into the back half of the year with Kiavi, Democratized Prime, and our core Connect business all pulling in the same direction. Thank you, and we will now open up the queue for questions.
Thank you very much, Ms. Gill. Ladies and gentlemen, at this time, the floor is now open for questions. If at this time you do have a question or a comment, please press star 1. If at any point your question has been addressed, you may remove yourself from the queue by pressing star 2. Again, we kindly ask that you please limit yourself to 1 question and 1 follow-up, and pick up your handset when posing your questions. We'll go first this morning to Patrick Moley of Piper Sandler.
Yes, good morning, and thanks for taking the question. So I guess I just was hoping you could maybe elaborate on the 3Q guidance for origination volumes. Seems like you're expecting strength in July to continue throughout the rest of the quarter. So if you could just maybe talk about some of the assumptions that are baked in there. And then in terms of the new partners that were added in the second quarter, could you maybe just talk about the size? I know you said one of them was already one of the largest players on Connect, but just maybe the nature of those new partners added and how we should think about them contributing to volume into the back half of the year. Thanks.
Sure. Good morning, Patrick, and I'll go first and then hand it over to Michael for the partner section. So last quarter was the first time that we guided as a company, and back then, as we were talking about during the call, we leaned towards being a little bit more conservative. We had some new partners that onboarded in late Q4 and into early Q1, and volume ramp timeframe was in a range, and so we wanted to be prudent as much as possible last quarter. This quarter, we feel very strongly confident in the range that I mentioned before. As I indicated earlier, July was $1.7 billion. We understand from looking at history how August and September would come in. I would also take into account some level of business days in the months of August and September, which is why we're pretty confident around the $5 billion midpoint of the range that I mentioned. I'll turn it over to Michael on the partner expectations.
Thank you. So we're operating with a well-oiled go-to-market machine. Of that 102, it's pretty broad-based around the different segments of the market, meaning independent mortgage banks, banks and credit unions, IMBs, fintechs, et cetera. And at the same time, you also have a pretty nice range of size. So we talked about in the quarter in Q2, we had a partner go directly to FIGR Connect and become one of the largest. That's not necessarily the norm, but it's also not something that we expect to be unusual going forward. So we're attracting a broad range of customers in terms of both the type, but also the size. And we have a number of different go-to-market motions that we see as very successful and continuing to expand.
All right, great. That's it for me. Congrats on the quarter.
Thank you.
We'll go next now to James Yarrow of Goldman Sachs.
Good morning, and thanks for taking the question. I hoped we could turn perhaps to the buyer side of the consumer loan marketplace. Could you just maybe provide some additional color on what sort of buyer types you're adding and what percentage of those are engaged with FIGR Connect?
So all our buyers are engaged with FIGR Connect. That's the way that they buy on the platform, and all the incremental buyers we bring are Connect first. And the range is pretty broad and consistent with what we have talked about before. So it's going to be a combination of insurance companies, asset managers, credit funds, and we continue. In fact, earlier this week, we were out meeting with a very large asset manager that has not yet purchased on the platform. So there's a number of opportunities, and Todd Stevens and his team dedicate all of their time to meeting with asset managers, both existing and new, to continue to drive momentum. And one thing that he often shares is, volume begets volume. So people like to buy at scale. And as we get bigger, it actually opens up the opportunity for more people to join because people want to see that consistency and want to know that if they do the work on understanding FIGR, there's going to be volume to purchase in the future. So our growth is, back to that flywheel concept, adding more buyers and therefore helping us continue to take in spreads and therefore bring more volume in a very virtuous cycle.
Great, thank you. Just as a follow-up, I just wanted to level set on the take rate. Could you just clarify whether there have been any pricing cuts that have affected the take rate, or is the lower take rate entirely from mix shift into new products? I think that's an important distinction. And then if that's true and there have not been any take rate cuts on the pricing side, do you see any risk that you might have to cut pricing in the near term?
Great question. And you're right, it's good to clarify this. We don't see take rate as the take rate performance in this quarter coming from price cuts. Instead, take rate's really a product of the success of FIGR Connect. And we've talked about FIGR Connect as having the lowest take rate of the three ways we do volume: direct to consumer, FIGR as intermediary, and then Connect. And so because we're seeing partners that are coming direct to Connect, that's a dynamic we didn't necessarily appreciate what happened as fast as it is. And so that's why we went 9 points as a percentage of volume in the quarter in terms of what FIGR Connect was. And so you see take rate as a really result of that strategy. It's something that we want to happen. We're excited about this. It's not coming from partner pressure. And what you'll see is that 3.5 to 4, as I mentioned in the prepared remarks, is still appropriate, but we see the lower end of that range as realistic for the coming quarter.
That's really helpful. Thanks a lot.
Thank you. We'll go next now to Ryan Tomasello with KBW.
Thanks, everyone. Maybe dovetailing off of James's question on the take rate, I think it would be helpful if you could maybe quantify where the pricing floor is in the Connect channel, particularly when considering, I think, the tiered pricing volume discounts that you have for your larger partners, which I think is something that may not be as appreciated by investors. So maybe just as a starting point, sharing where that lowest pricing tier is on Connect, and that would be irrespective, obviously, of like the volatility that gain on sale can cause the take rate. Thanks.
Sure. So I'll talk about so our pricing is in terms of ecosystem fees rather than take rate, but obviously they're related. So our kind of top volume tier pricing is right at the bottom of the range of take rate, meaning if you're a partner that goes to the highest tier, in general, you're going to be at the bottom of the take rate range we provided. Of course, there's other dynamics such as servicing fees, interest rates, as well as whether or not the loan is securitized. All of those impact take rate. And then you have sort of volatility and gain on sale. So there's a couple things that are moving there, but the pricing that we do is generally aligned with the bottom of the range. I'll note, though, that when we set the pricing, we don't actually set it based on take rate. We set it based on contribution margin. So one of the things we want to do with the Kiavi acquisition is give the analyst and investor community a bit more color into how contribution margin looks, because that trajectory has actually been both better and more stable as a percentage of volume over the past couple quarters. So I think that additional disclosure will be helpful. We just want to give it when we have full line of sight into Kiavi to make sure that we really only have to explain it one time to you all and not waste your time.
That's helpful, but I guess maybe a follow-up to that, help us understand why you're talking about 3Q take rates at the low end of that 3.5 range when you're saying that low end is only it aligns with your largest volume partners on Connect, and considering the mix of the business with a lot of smaller origination partners, the business is not all on Connect. Why are we talking about the all-in take rate across the entire business already hitting that floor? Am I missing something there?
No, you're not missing anything. 65% of the volume is already on FIGR Connect. In general, we see that increasing in the quarter. And then we have the general variability that comes with other business models, as well as differing mix shifts potentially on servicing, as well as mix shifts that come from the securitization parts of the business. So based on the visibility that we have, we continue to see the low end of the range as realistic, but we'll continue to update you if that changes.
Great. Thanks, everyone.
We'll go next now to Rob Wildhack of Autonomous Research.
Hi, guys. Maybe on that last line of discussion, you've got nice growth in FIGR Connect volumes, but growth in ecosystem and technology fees is not growing as fast. And I think this quarter, just isolating those two lines alone, like ecosystem and tech fees are less than 3% of Connect volumes. So why is that? Like, is there some kind of non-volume related component that's in ecosystem and tech fees or something that we're all missing here?
Well, I'll start, and Macrina is the closest to the composition of take rate, but just remember that, for example, servicing fees are a separate line item. And so that's one of the components. And in general, this is the first quarter that ecosystem fees are the largest on the P&L. So it continues to reflect that migration to FIGR Connect, but I'll turn it over to you, Macrina.
Yeah, and what we also have as part of the take rate is that we have the mortgage servicing add addition, so gain on mortgage servicing that goes onto our revenue. the total part that you see on GAAP P&L includes fair value, and we actually adjust that out as part of adjusted net revenue. So I do want to keep you honest in terms of we're not taking the full GAAP amount. We are taking just the addition of the new servicing that is being added as part of our take rate.
Okay, but if I just isolate ecosystem and tech fees, so no servicing, no origination fees, and divide that by FIGR Connect volumes, like that number is coming down over time. And so we hear you on, no pricing cuts or anything like that, but what would be the driver there?
So it's going to be the tiers that people hit on volume. So I just want to be super clear on this point. We're not renegotiating our volume tiers with partners, but when we sign up partners, we establish volume-based pricing that comes down to incentivize partners to do volume with us. And so as they hit higher volume tiers, their individual pricing comes down. But in general, as we talked about, that's going to put us at the lower end of the guided range we gave. Is that making sense?
It does. Thanks. And then if I could just sneak one more in, loans on the balance sheet up to like $600 million. Can you just remind us of the strategy? Because we hear you talking about how FIGR Connect is less balance sheet intensive and third-party demo prime is growing nicely. And does that continue to grow, or is like 600 maybe the cap?
Okay, so I'll just put this into parts. So balance sheet loans was about $600 million at the end of the quarter. We had about $360 million of democratized prime that was supported with FIGR's borrower demand. This is pretty consistent with what we had back in Q1 moving into Q2, so that number really hasn't changed. We are continuing to add more in terms of third-party democratized prime loans from the borrower side, which I mentioned in my earlier remarks. The other part that is making up the $600 million is we do have loans where FIGR does go direct to consumer, where FIGR is also the acting intermediary before the loans are sold on to Connect. And as you saw, our growth overall in volume from Q1 to Q2 is quite significant. And what that translates to is that we hold on to these types of loans, whether we're going direct to consumer or FIGR as an intermediary, around 3 to 4 weeks at a time before it's sold on to Connect. And that's because we want to be able to aggregate the loans before it's sold. And so you're just seeing really a natural way of seeing that volume growth is translating into loans on our balance sheet for a temporary amount of time before it's sold on in Q3.
Got it. Thank you.
Thank you. We go next now to Dan Dolev of Mizuho.
Hey guys, really nice results here. Fascinating growth, triple digits. Wanted to ask about the SMB home improvement diversification. Looks really interesting here. Any comments you can make on this strategy and what it does for FIGR would be really helpful for investors. Thank you.
Thanks, Dan. It's interesting to reflect on that because it shows a number of highlights of what FIGR does best, right? You have the 35 trillion of home equity outstanding. And as we talked about, in any interest rate environment, that's going to be really attractive. And so what's happening is people who have that home equity are using that to fund small business financing. And that's a new avenue for us. We're lapping about a year of us launching that. And it's already grown to a meaningfully significant portion of our volume. And it's a new go-to-market motion. So back to what's driving that 102 partners is we're now signing up people that would historically not have been in the mortgage business whatsoever. They're business loan originators, brokers, fintechs, but they're able to use FIGR because we make it so simple and easy and inexpensive. And that's a big part of our broader strategy is to take partners that normally wouldn't be in this space and give them tooling to join our platform, join our marketplace, be capital light, be part of Figure Connect, and you're really seeing that strategy borne out. We're also seeing a similar dynamic in the home improvement space. So this would be traditionally unsecured loans towards things like home renovation, roofing, pools, et cetera. That's starting to grow really nicely as well, and we're excited about the momentum we see in that space. And as I pointed out on the call, we've decided to make depositories a specific focus within the new vertical approach that we're taking, which is really a go-to-market motion in terms of how do we align internal resources and mobilize. And we see just massive opportunity there as well. So a lot of momentum on growth, which is our focus, and continuing to bring that growth into Figure Connect, that capital light marketplace. That's our strategy, and we're continuing to execute accordingly.
Thanks, Michael. Really, really nice results. Congrats again.
Thank you. We'll go next now to Kyle Peterson with Needham.
Great. Good morning, and thank you for taking the questions. Nice results, and not to belabor the take rate, but wanted to start off there and maybe see if you guys could directionally give us some impact on, you guys mentioned a spike in interest rates kind of weighed on some of the gain on sale this quarter, or is expected to in the third quarter. But I guess how much of a headwind is that expected to be, and like what's the relative impact of that that's kind of pushing you towards the 3.5 range? And then I guess if rates stabilize, should that headwind kind of abate after this quarter?
Good morning, Kyle. I'll get started, and then Michael, feel free to add if you'd like. So in our prepared remarks, we did talk about some of the rate headwind in terms of gain on sale, and gain on sale is another portion of take rate that we consider, and it does get impacted by the macro markets. And so when rates are wider, then we are going to have a little bit less of a gain on sale. When rates are tighter, then we're going to have a better gain on sale, which is what you're seeing, and that's more volatile compared to what we would see for ecosystem fees and technology fees. The other part that I would also mention is, although our take rate is coming in on the lower end of the range, Michael had mentioned earlier as well, we are seeing a lot of success in Figure Connect. The Figure Connect contribution margin is coming in really nicely. That is why you're seeing additional growth in our adjusted EBITDA margin and growth in our profitability as well. Michael, do you want to add a few more things, or good?
No, just agree. And we were simply talking about Q2 there. We can't yet know all of the interest rate movements for Q3. We're just letting you know that that volatility will always be a part of the Figure as intermediary revenue line item, and that's why we're so focused on growing Figure Connect, because it gives us much more stability and also that capital light. So that's really our focus.
Great. That's helpful. And then I guess as a follow-up, it's great to see Agora. Seems like the volumes there are really starting to inflect higher, and there's a lot of good things happening on the auto front. I guess, should we think about in terms of timeline and additional asset classes that you guys are spinning up? Is this kind of the playbook and time frame is from when you get someone or an asset class announced and signed to when the volumes start to really inflect and start to contribute a little more meaningfully? I guess, like, how is like this quarter, like couple quarters time frame, a good way to think about the ramp time to get these upscaled and running, or can that cycle time reduce over time? Just like, how should we think about additional asset classes and how long it'll take to ramp them up?
It's a great question, and as I talked about, I think AI is critical here because it's something that we can leverage to reduce what is a very complicated process to ingest and standardize third-party assets. And so when we bring on Agora as an example, we're thinking broader than just one individual auto loan originator. We're thinking, how can we set the standard for the way that auto loans and then ultimately auto securitizations can operate in a tokenized way? And so that's the approach that we're taking. So there is probably, to open up a new asset class is going to be much more significant than to open up a specific originator onto that asset class, but because everything's new for democratized prime right now, those two are the same thing. But we would expect another auto originator, for example, to go much faster than that. And I mentioned this in the prepared remarks, but I think you're going to start to see us in the coming quarters work on making FIGR Connect as a concept work for permanent sale and securitization of the assets that are being financed on democratized prime. And that's really going to start to turn the flywheel, because we're going to be able to take originators, give them short-term financing with democratized prime, but then take those assets and get investors that want to buy them permanently or securitize them and use FIGR Connect, earning those ecosystem fees that we love so much in the process. So more to come there. And that blueprint that you've seen is a really good way to look at a new asset class rather than a new originator.
Great. Thanks so much.
Thank you. And ladies and gentlemen, that is all the questions that we have for today. So that will bring us to the conclusion of today's conference call. We'd like to thank you all so much for joining the FIGR Technology Solutions second quarter earnings conference, and wish you all a great day. Goodbye.
Give me 1 second in the music on my end too. All right. Yeah, really good earnings call. We saw the market initially was, for whatever reason, I think it was a take rate. I mean, you heard it with the analysts. Not liking FIGR. It's up 6% now in the pre-market. Of course, part of that is at the inflation read, which is a good read. Yeah, I like these. Analyst questions were pretty funny. It's a very common thing in business where you have different tiers depending on the volume that people drive. And if you have somebody that's all the way at the high end, they're like, hey, we're bringing a ton of volume, usually you see a little bit of savings in terms of a take rate. And we had two analysts ask back to back, where they're like, are you slashing rates? What's going on here? And it's like, do you not understand how business works? Like, oh my goodness. It wasn't the dumbest analyst questions that I've heard, but probably the second one was, because the guy literally before him just asked. So, man, analysts do better. But regardless, the market kind of gets it. Now, the most exciting thing I think that came out of the call was that they talked about basically shifting towards FIGR Connect, which is this. It's what their partners use. Again, FIGR does their own originations. They have their own balance sheet lending that they do, but then they also have these platforms, and that's the asset light stuff. That's where the take rate really comes in. That's why it was a big focus here. It came in at the lower range at 3.6, partly because of mix shift. Some of the newer products have a little bit lower line, and then the wells that are onboarding that have the massive amount of volume, that it carries a little bit lower take rate. So, it's fair enough to ask about it, and the market is certainly focused on it. But man, to ask twice and not understand that, it was just laughable. But anyway, Michael Tannenbaum, the CEO, mentioned that they had previously guided for 60% near term of their revenue coming from the platform. Now they're like, hey, it's 70. This is accelerating really fast. Essentially, what happened is a couple of things. In the onboarding process, we already saw the slide in the earnings call. It usually takes about 6 months there. And by the way, I will still stay live until right after the market opens here in about 80 minutes. So not too much longer, but I do want to see how things open up. But when a client usually onboards, they begin to shift volume onto the FIGR platform, and that usually scales by about 200% from their existing previous volume. Like they see growth, the customer does, in their own volume because they onboard FIGR, and they're like, oh man, we're connected to all these different people. We're able to save all sorts of different efficiencies. We can do it faster as well with FIGR. This is great. But it takes about 6 months. And then there's also a curve there. It takes time to basically onboard. Now, they mentioned with Agora, for instance, that their use of AI has basically helped that process come along a lot faster and be a lot easier as well. So they're driving efficiencies both through crypto and also AI. They're looking at doing the same once the Kiavi acquisition, which is that first lien, the mortgage market, that is going to fall in the second half of the year. Sounds like it's going to be more late in the second half of the year. Otherwise, I think they might have said quarter three. But yeah, that's going to drive a lot of volume. But it's also going to be able to be onboarded there much more rapidly just because of their success here. And then they're seeing partners that are, instead of basically there's an intermediate step that that partners have in the past oftentimes done rather than just go directly onto FIGR Connect. They're just bypassing that now. They're just like, nope, directly to Figure Connect. Why mess around with this intermediate stage? We're just going to go right onto the direction that we're going to go to anyway because it's so accretive to them. So it's incredibly bullish, but again, it does mean just a slightly lower take rate, but it's still within the range. The 3.5 would be the lowest we see, so 3.6. It is what it is, but yeah, the numbers speak for themselves. Over 100% growth in almost everything. A little bit of fade here, 5.44%. We got about 6 minutes to open as well. Anything stand out to you guys, or do you have any questions on the earnings itself? It's one of those things where I hope the analysts pay a little bit closer attention next time, where they have somebody that just understands basic business principles. But there were some really good questions too. So I'll go over, of course, the earnings numbers, and we'll do a review video. It's a busy week, so I don't know that that's going to come out this week, but we'll definitely talk about it by next week as well. So then I mentioned also, this is one of those where the market may not pay too much attention to Figure. We'll see how it opens up here and how it does. It's nice that it's up 5%. We might be range bound for a little while, but I do think by Q4, which we're nearly there, I think that fintech in general, lenders also will do pretty well, especially after midterms. And so this is one that probably, if I had to do the stock giving challenge, which I've won, well, I'm assuming I'm winning with Air Test Systems this year because it's up over 400%. I've won 2 out of 3 years. I think that Figure might make it 3 out of 4. But next year should be good. This year we'll have to see. Yeah, I'm getting some questions on FIGR. I don't know anything about it. And I always call it like it is. If I don't know something, I'll just say I don't know. So appreciate the question. Yeah, 4 more minutes till we open up. In the pre-market, we're looking at S&P and NASDAQ up just a little bit, not too surprising given the inflation read. We're still seeing a little bit of fade on CoreWeave and also, I believe, on Nebius. Nebius is down about 2.8%. Probably should have pulled up the Webull platform here just to show you guys the numbers. Iris Energy is up about 4.5% as well on that Horizon One news. Again, they're delivering 50 megawatts. So they're beginning to deliver capacity to Microsoft in that partnership. And so what you'll see with Iron, and I'm sure they'll talk about it, I think that their earnings is August 27th. You'll begin to see them diversify a little bit more away from what they're doing on the crypto side, which is the market doesn't care anything about right now, which is one of the reasons why Figure is trading at where it's at. But that can be our alpha and that our opportunity as well. So yeah, I think like a lot of people are asking, is this a good time or a good place to buy? Make sure you do your own due diligence. You don't need to know every single thing about Figure, but know what you own. For me, I added this morning, and I was like, hey, whether the stock price rises or falls, these are great numbers. And I would like to add to this name. There's a lot of names I'd like to add to in my portfolio, but there's only so many gains, so much money there. Even though the market has been very kind over the last 2 weeks. So let's see. I appreciate that. He says, love for always getting your objective stance on earnings, the way you look at stocks. Last time I really understood your stance about PayPal and why did your exit. Yeah, when a thesis breaks for me, or even if I'm bullish on something, but I see something that could be a concern. I say that. Like yesterday, I covered the Nebius earnings live with the other guys, and I have a 1 share just for fun. I've owned a meaningful amount of Nebius twice, and I've sold when it ran a little bit too hard, and I had covered calls that went underwater. But like there, I was saying, hey, the focus is on the Vineland campus, which they answered very well. No weak spots in that earnings. It was phenomenal. And people were like, why are you being so bearish on Nebius? Like, at least for me, like some people like cheerleaders. I'm not a cheerleader. I'm not going to just be like, everything is great and let's pretend that it's fantastic. Even like in Palantir, I'm like, hey, international growth, it's lackluster. They've added 10 clients over the last year. That's not great. Across the board, the numbers are great. It's an amazing company. I think it's not unattractive here. It's run a lot. It was actually getting cheap for a while. But if I see a weak spot, I say it. And if there's something I don't like, but I'm like, hey, this is really bullish for them, I also say that as well. Roy, could you please explain about how I think lending rather than leading works about the high values, lower take rates. Trying to understand. Yeah, you can think about it like it's not just with lending, with any business thing there at all. If if you're going to go buy something, for instance, on a lot of websites like Amazon, you can go on Amazon and there's some products that you can go and if you're ordering like 20 or 30, they're like, hey, we'll reduce the price that you're paying by this amount. And so you'll see that there's a volume discount. It's that exact same kind of deal with these partners that are doing a lot of lending through Figure's platform. If they're bringing a tremendous amount of volume there, Figure's like, oh man, you're bringing a lot of money to us. And in order to keep you as a customer and client, they've established this. It's not like a special deal. They're like, at this volume range, you're going to pay a little bit less than if you're a tiny partner, you're just going to pay the full amount. And so a little bit of a discount from volume, and it works that way across the board. Shares are up before the market opens, and the market just opened right now. We're up 5%, 6%, 6.5% on Figure. I probably should have pulled the brokerage open here. Yeah, a lot of things are running. Fintech's running. CoreWeave is now positive, 1.85%. Robinhood up 2%, Palantir 1%, Nvidia about flat. Nasdaq and S&P just up a little bit as well. Of course, it's early. Air Test Systems down 7%. I don't think on any specific news. That one is volatile both directions. It's one of the reasons why it's not bad to take some gains along the way. Nebius is about flat. Iron is trading about 5% as well. A lot of tech is green today, at least to start. Of course, it's very early. We'll see how it opens up. Corey now back in the 110s, which is nice. Like Walmart has so much buying power, they get better pricing. Exactly. Yeah, it works that way across the entire business world. And why two analysts, much less one, don't understand it is pretty shocking. Nebius average was 28 for 5,000 shares. My guy, congrats. That's awesome. Average for Figure is 26 bucks for 20,000 shares. Figure is giving me the same vibes as Nebius did a year ago. It may take longer for the market to kind of get it, but yeah, I think like I'm looking out long term, but I really do think next year is going to be very, very different and very kind for Figure. I've been interested in this company since IPO, but I didn't buy. I waited to buy, waited to buy. I think my first buy was in March, maybe, when it had fallen to a reasonable range. The market was disrespecting it. It's been very volatile. The Agora, not the, well, the Agora partnership, but the Kiavi acquisition that they're doing, I don't know that the market can ignore that. Whatever happens with rates, yeah, real world assets and tokenization, dude, yeah, it shouldn't be trading here. And next year, it's going to be pretty incredible as it continues to grow 100% year over year for a while. They do use blockchain technology. They have their Provenance blockchain, which is what they're able to get all these efficiency gains out of. I wish I could find that slide. It's going to bug me. I'll try to recirculate it. But versus what traditional lenders have done with HELOCs, Figure is able to do it more efficiently in terms of time. It's a 5-day turnaround, or it can be as early as 5 days. I think average is 15 versus the industry-wide average is well over 30 days, and you don't hear about 5 days at all. But also in terms of the basis points that they save, so they can offer even more attractive rates and really get higher margin as well on their lending side. But yeah, they're able to use that as well as the AI technology. But it is a crypto name, but it's not really impacted by crypto prices that much. And then one last comment here. I'm wondering about BM&R, Mr. Beast FinTech stuff that will launch probably with ads around Christmas and New Year's. Yeah, I didn't hate the Mr. Beast thing. It'll be interesting to see what that platform actually becomes because they are building that financial platform. I didn't like the timing of it just because it was right after the request for more shares to buy Ethereum, and then they buy shares of Mr. Beast Industries. So I'm still holding BM&R. I still think that there's opportunity there, basically just because of how Ethereum will play out. But yeah, if like between Figure Technologies and between BM&R, I'll be buying a lot more Figure and maybe some BM&R as well. But Figure, man, yeah. So one last read on the market. Figure's up just now 3%, faded a little bit. CoreWeave 2.5%, SoFi 1.5%, Robinhood 3%, Palantir 1.5%. A lot of tech up. Nvidia is up about 1% as well. So anyway, Thank you guys so much for tuning in. I will get out a earnings reaction video at some point. It won't be today. There's too much happening. I am also going to be live tonight at 7 p.m. With Nate and with Jose. We'll be talking about Data Center Monthly. So there's so much there to cover. Of course, we'll talk about Nebius and CoreWeave, the earnings. Jose is going to talk more because he's invested in IRN about expectations and this Horizon news as well. The macro stuff, the Michael Burry shorts, what Market Shkreli said on CoreWeave. There is a lot happening there. So as always, guys, thank you for watching, commenting, subscribing, and until next time, happy investing.